Right now in Germany, the median household has roughly 83,000 euros in total financial savings. Not invested wisely, not compounding in the market, saved. And that is the median, meaning half the country has less. Meanwhile, the Deutsche Institut für Altersvorsorge estimates that a German household needs approximately 1.3 million euros to maintain their standard of living through retirement. The gap between where most Germans are and where they need to be is not a minor shortfall. It is a structural problem decades in the making. But here is the part the German financial industry never tells you, because telling you would remove the fear, and the fear is what sells products. That gap runs in both directions. Some of you are sitting exactly where you need to be without realizing it. And the reason you do not know is that building a top 5% retirement in Germany does not look the way wealth is supposed to look. It does not come with a Porsche in the driveway. It does not mean dining at Michelin-starred restaurants every weekend. It looks like 3 specific behaviors that most people find too unremarkable to sustain. This script is about those 3 behaviors. And by the end, you may discover you are further ahead than you have ever allowed yourself to believe. So what does top 5% actually mean in Germany? According to the Deutsche Bundesbank's 2023 Household Finance and Consumption Survey, the net worth threshold for the top 5% of German households starts at approximately 910,000 euros. The top 10% begins at roughly 620,000 euros. And the median German household net worth, the person sitting exactly in the middle, is around 172,000 euros. So the gap between median and top 5% is roughly 738,000 euros. And the behaviors that close that gap are not complicated. They are consistent. They are frankly dull. Before we get to behavior 1, let me introduce you to 2 people. Call them Thomas and Marcus. They work at the same mid-sized manufacturing company in Stuttgart. Thomas earns 68,000 euros a year. He drives a 7-year-old Volkswagen Golf with a small scratch above the rear wheel arch. He brings lunch to the office 3 days a week. He and his wife take 1 holiday per year, usually somewhere in Bavaria or the Adriatic coast. Marcus leases a new BMW 3 Series, talks about individual stock picks over the canteen lunch, explains his side investments to anyone who will listen. He has 2 trading apps on his phone and recently moved capital into a thematic tech ETF because he had a strong conviction about AI infrastructure. Marcus feels like he is building something. Thomas does not feel much of anything in particular. Keep them in mind. We will return. Behavior 1. Your savings rate causes mild, persistent discomfort. Here is the current average savings rate in Germany. According to Destatus, German households save approximately 11% of disposable income, significantly higher than American or British households, and genuinely something to be proud of nationally. But here is where the story gets complicated. That 11% figure is pulled upward by a small group of high-income, high-saving households. The distribution is not even. A large portion of German households save closer to 4 to 6% of net income once you strip away mandatory pension contributions to the Deutsche Rentenversicherung. And mandatory pension contributions are not savings in the wealth-building sense. They are deferred income with a fixed return structure controlled by the state. They will not make you wealthy. They will, at best, keep you stable. Now compare that to the savings behavior of people who actually build substantial retirement wealth. Research consistently shows that households reaching the top 10% of retirement wealth maintained voluntary savings rates, outside of mandatory contributions, of 15 to 20% of net income over long periods.
Not de Pflichtbeitrag to the Rentenversicherung.
Additional, discretionary, deliberate saving. Here is the calculator moment. Say you earn €60,000 gross annually. After taxes and social contributions in Germany, your net take-home is approximately €38,000. A 5% voluntary savings rate on that net income is €1,900 per year. A 20% voluntary savings rate is €7,600 per year. After 25 years compounding at 6% annual return in a diversified ETF portfolio, the 5% saver accumulates roughly €105,000. The 20% saver accumulates approximately €420,000. Same salary, same market, For times the outcome from a single percentage decision made early and held consistently. The mild discomfort of a 15 to 20% voluntary savings rate is not evidence you are doing something wrong. It is evidence you are doing something rare. Behavior 2. Your portfolio bores you. This will offend some people. It should. There is a certain type of German investor, and their numbers have grown significantly since the Robinhood-era trading boom reached platforms like Trade Republic and Scalable Capital, who checks their portfolio before breakfast, rotates between individual stocks, and recently moved into a semiconductor ETF because of a thesis they read in a Finance Plus video. By every metric of engagement, they are active. By every metric of actual outcome, they are almost certainly underperforming a simple, boring, low-cost global index fund. Here is the data. The Spiva Europe scorecard consistently shows that over any 10-year rolling period, between 85 and 92% of actively managed European equity funds underperform their benchmark index after fees. Not 50%. Not 60%. More than 85%. Now here is where the German market has a unique structural problem. The average annual management fee for actively managed funds sold through German banks and insurance wrappers, particularly those bundled inside Riester-Renten or Lebensversicherung products, runs between 1.2% and 2.1% per year all in. Compare that to a Vanguard FTSE All-World ETF available on any German broker, which carries an ongoing charge of 0.22% per year. Calculator moment 2. Two German investors, both 35, both starting with 50,000 euros and adding 500 euros per month for 30 years. Both portfolios earn 7% gross annually. The only difference is cost. Investor 1 holds low-cost index ETFs at 0.3% total annual cost. Investor 2 holds an actively managed fund inside a traditional bank wrapper at 1.8% total annual cost. After 30 years, Investor 1 has approximately 795,000 euros. Investor 2 has approximately 590,000 euros. The difference is 205,000 euros, not from bad market timing, not from risky decisions, purely from fees compounding against them silently for 3 decades. If your portfolio is 3 broad ETFs, perhaps an MSCI World and Emerging Markets Fund, and a small cap tilt, auto-invested monthly via a SPAR plan rebalanced once per year, you are not doing something boring. You are doing something most German investors actively paying for complexity will never match. Behavior 3. Your net worth is not mostly sitting in your apartment. This is the behavior that separates people who will retire freely from people who will be property rich and cash poor. And in Germany, this distinction matters in a way that is specific to this country's financial culture. Germany has historically been a nation of renters, but that has been shifting rapidly. Between 2010 and 2022, residential property prices in Germany's major cities roughly doubled. In Munich, average apartment prices reached over 9,000 euros per square meter at peak. In Berlin, prices tripled over the same decade before the 2022 correction. Many Germans who bought property in that window are sitting on significant paper gains. Here is the problem. Paper gains in a home you live in are not retirement income. They are appreciation you cannot access without selling your home, taking out a Beleihung, or executing a complex equity release. And the German mortgage and lending environment as of 2025, with interest rates on new fixed-rate mortgages running between 3.8% and 4.5% after years near zero, has made the structural trap more expensive than ever to navigate. Here is the insider fact the property enthusiasm headlines are not telling you. According to Bundesbank data, for German households in the 55 to 70 age group with net worth between 200,000 euros and 600,000 euros, immovable property, principally primary residences, accounts for between 62% and 74% of total household wealth. More than 2/3 of everything they have built over a lifetime is sitting in walls they live in, producing no income, requiring ongoing maintenance costs, and inaccessible without major life disruption. Compare that to the composition at the top of the wealth distribution. For German households in the top 5% of net worth, financial assets, equity portfolios, ETF holdings, business equity, represent the dominant share of wealth. Property is where they live, not how they retire. There is a meaningful geographic dimension here. a household in Hamburg or Frankfurt that bought property in 2013 and then kept contributing aggressively to a depot at their broker is in a fundamentally different position than a household in Munich that stretched to its absolute limit to buy in 2019 and has had almost no capacity for equity investment since. The Münchner who is house rich is not necessarily retirement functional. The Hamburger who rented and invested the difference may be further ahead in investable terms despite lower perceived social status. This is a comparison the German financial press almost never makes directly. Now back to Thomas. What Thomas did over 15 years was not accidentally profound. He maximized his company pension matching, invested additionally through a depot at a low-cost online broker, predominantly a global index ETF SPAR plan, and made normal, unhurried mortgage payments on a modest apartment in a mid-sized Baden-Württemberg city without rushing to overpay. His property appreciated, of course. But when Thomas recently ran his numbers, property equity represented about 31% of his total net worth. The other 69% was growing, compounding, and accessible. His savings rate was, as he described it, a bit tight but always manageable. He never discussed individual stocks. He has no opinion on Tesla. Marcus is 47 and has a BMW on lease, strong market opinions, and approximately 58,000 euros across 3 accounts. Marcus's portfolio is loud. Marcus's portfolio is not moving. The people who retire in Germany quietly, early, and with genuine financial freedom almost never have a story worth telling at a grillabend. They did not find the right stock. They did not time the Immobilienmarkt perfectly. They found a savings rate that was mildly uncomfortable, held a boring portfolio that cost them almost nothing in fees, and made sure their net worth was not mostly trapped inside their own 4 walls. They just did not stop. The speedometer ran. The miles accumulated. And one day they looked up and realized they were somewhere most people only read about. Don't announce it. Just keep driving.